Welcome to this Killik Explains Finance video. Now in part one of the first time property buying basics video series, I dealt with should you rent or buy, very briefly, no right answer but do weigh it up carefully, and mortgages, the very basics, the different styles, repayment, interest only and different ways of calculating interest. So in part two, I'm going to assume that that's all done and dusted. So part two is going to be breaking down the jargon, some useful terminology that as a first time buyer you ought to be aware of. Or the impact of, let's say. So what is it? Well, let's deal with LTV, loan to value. That's something you'll get thrown quite a few times if you go to a mortgage lender potentially. Gearing, that can work both ways, good and bad. And negative equity, which unfortunately is a risk as property prices have stagnated recently or even fallen in some parts of the country. And bear in mind, I'm saying all this in July 2018. No one knows which way property prices will go next, but that's something to keep an eye on. Now, let's take them in turn. So what is LTV? It's quoted a lot, loan to value. Well, basically, lenders usually set a maximum LTV. All right, and that works like this. If the property you're after is worth £200,000, let's say, and the most they'll lend you is £150,000. You've gone to a mortgage lender, you've got your ducks lined up, you've got your credit history lined up, okay, you've demonstrated sources of income, all that good stuff. So you've been through all their tests and even interviews in some cases, and they've said, we'll forward you £150,000. What they're saying is the maximum LTV, to use their jargon, is 75%. Now that assumes, if you're going to go ahead, you can fund the rest of the property some other way. So maybe you've got a decent deposit. All right, if you haven't got a decent deposit, then you need an LTV that's higher. And clearly that will influence potentially the deal you can get with a mortgage lender. So the bigger the deposit, not surprisingly, the more competitive the rate, whether fixed or variable, they'll tend to offer you. All right, and in some cases they may just say, I don't care. We consider you to be a risk in some way, so the maximum LTV is what it is. And for first-time buyers, they'll often need it to be higher than 75. They might need 90 or even 95. So there's one bit of jargon. Gearing is another. Now, property fanatics, buy-to-let fanatics, for example, say gearing's brilliant. Be careful. It's okay, but let's take a look at it. So rising prices allow borrowers to build equity. How? Well, essentially, imagine you borrow £150,000 to fund a £200,000 home. Now that gap suggests that the other £50,000 has come from something, so that's presumably equity. So you've put £50,000 down. Prices then rise to 250 from 200. And let's say you decide to sell the property. Now this could be a bad idea for all sorts of reasons. Property can be illiquid. You're going to get walloped for cancelling the mortgage, outstanding mortgage, cancelling it early, unless you've got a clause in there that allows you to do it, can be incredibly expensive. But let's hypothetically say you're going to do exactly that. So you sell the property. What would happen next? You could, in theory, clear the debt you borrowed. And what's more, have £100,000 left over. That suggests you've doubled your original deposit. Because you started with 50, you've now got 100, let's say. And that's partly or substantially down to gearing, the fact you borrowed. However, it can also work in reverse. Imagine prices fall. So this time you borrow 150 to fund a £200,000 home. So you've got a 75 LTV if you like. Prices then fall to 150. So this time the property prices have gone down, all right, against you. If you sell, hypothetical, there's other reasons why you might not want to sell and clear the mortgage and so on, as I mentioned, you've actually lost your £50,000 deposit because now you've got enough to sort of clear the loan, theoretically, ignoring costs, but you've lost your £50,000 deposit. So that is the impact of gearing in reverse. Okay, your loss has been kind of magnified in that sense because of the loan. Now, just a word about this. People will say this is the brilliant thing about borrowing to buy property. You increase the equity in your home and so on. Actually, got to be careful with that. All right, because if you are trying to pay for your only and main home, the point is property prices all rise together. So yes, you might make a bit of equity on a 2-bedroom flat. Then you'll find you need all of that to buy a 3-bedroom house, or a 3-bedroom house, you'll need all of it to buy a 4-bedroom house. In other words, as you go up the ladder, you'll need more equity anyway. So a rising tide floats all boats. So actually the benefit of rising prices and gearing is not as great for people who are only interested in funding their first and main home as some other buy-to-lettees might make out. Just be careful there. Okay, negative equity. Now, this is not a term you want to come across, but unfortunately it's something to be aware of. It limits your ability to move and remortgage. It limits the terms on which you can remortgage sometimes, so be aware of it. if a property's worth 200 mechanically and the mortgage is 250. Now, how did that happen? That didn't happen just now. I mean, the long gone are the days when people will actually lend you more than the value of the property, although there have been some crazy times in the past like that. But let's say you bought a property and it's fallen in value, taken you into negative equity. That is defined as the difference between the value of the property and the outstanding loan on it. So here, £50,000. And sitting in negative equity essentially means, as I say, you may struggle to move and you may struggle to remortgage. So watch out for that. There can be restrictions placed by the lender in that situation. Top tips, therefore, general tips, shop around. Always shop around. Shop around to get for your first mortgage deal. Shop around when you remortgage. Watch out, because the deal you got at the start of a fixed period, you may be able to get a better one from another lender at the end of it. Okay, keep an eye on that. Save the highest deposit you can. Gives you more flexibility. Save as much as you can, and that way you'll probably bring down your overall mortgage rate, puts you at less risk of negative equity. And thirdly, budget for everything else. So people sometimes think the bit I need to worry about is saving for a deposit. No. What about fees, stamp duty, moving costs and so on, which I'll deal with in another part of this series. There you have it. Any questions on those bits of jargon, LTV, negative equity or gearing, editor@killik.com, and to watch other videos in the series, or if you missed part 1, killik.com/learn.